Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, February 6, 2024. It's 11:03 a.m. Eastern Time, so I'm starting the video, so we're an hour and a half into the trading day. What I'm going to do in this one is just, I noticed there were quite a few comments under yesterday's post, so I'm going to address those questions and comments, and in doing so, I'm going to start out with this one. What's your take on LIT, the lithium ETF? I'll give you my thoughts there, and then look at a few more things that really address the stock market, and just some things I want to share there. I am looking, and I need to step it up and dig even deeper. I'm trying to find some more trade ideas outside, but my own personal trading, and that's pretty much what this site is about in a large extent. What I'm focusing on at the time is what I'm sharing. Now, with that being said, you are more than welcome, and I encourage and welcome post if you want to take on something else, something I'm not watching, an update on something I've previously covered but may have gone dark on lately. By all means, post it here. I do a far from perfect job keeping up with these comments, and sometimes I'll go in, look, there might be a few, but then someone posts something else there. Usually after a day or two, if I haven't replied, just bump it again in a new under a new post. But let's dive into it. So this is a question: what's your take on LIT? My reply, I'll just read it out here, but I'm going to actually go into some charts. That's twofold for trade ideas for anyone on the site. I do see some things now that's actually in a kind of changed a little bit from what I originally replied here. Here's what I said. I just did this morning. I said I don't have a very good read on the chart of LIT. And one of the problems with that ETF is that in the past, when I went to the website to get a list of the components to do a deep dive into their individual charts, most are non-U.S. companies without ADRs, which are U.S., that's American Depository Receipts, without U.S. shares to chart. It hit me right after I posted that. I was thinking of uranium. Uranium is the one, if I'm not mistaken, that has the bulk of the companies. You can't get a chart, at least not, they're either not listed publicly or they're listed on some foreign exchange that I don't have access to. So, that's that. But there are, and I actually, what I did, I have a basket of lithium stocks, watch list, I'm sorry. I'm going to cover that right now because there are some potential trade ideas there. So this is both an update to this reply, and we're going to go over a few charts. I went on to say, here's my daily chart. While I don't see evidence of a bottom, and I can't make a decent case to buy it here, I can say that it has barely, I'll show you in a second, by the skin of its teeth, positive divergences, and it's at extreme oversold readings on the RSI that typically precede at least a counter trend rally. What I mean by at least a counter trend rally is, most, not all, but a lot of major bottoms, major low trend reversals, end of bear markets, end of corrections come after divergent lows. So, at least looking at a bear market rally likely. And I went on to say, so, again, can't make a case to buy it just because it's down, just because it's oversold. I said I'd be on the lookout for any potential bullish candlestick reversal patterns and or a potential selling climax with a final sharp drop. That's what a selling climax is. You see that final kind of just, and it's almost there now, and I'm looking at it. I'm going to revisit the chart, and that's why I'm covering this in the video. There's a lot to this stuff. That's why I love doing these videos. It's just all the little nuances and little details that I could sit there and take me 3 hours to type up in a video. On a post with just written notes. And I just find it more efficient to kind of air my thoughts out here and everything I see. So, there is a spike in volume. You can see here these white bars. Nothing huge, not textbook, but this final leg down does have the potential to be a selling climax. It would be better to see bigger volume and even almost a straight down drop. That's some of those are. That would be a textbook bottom. But what I can show you, and as I said in that reply here, this is the deepest oversold reading we've been at. I've put the crosshairs here. You're down around 20. And going back in time, the last time we were there, here's how you can do it. You put a horizontal line on your volume, or I'm sorry, your PPO. And this LIT, the ETF, has not even been that oversold since back here. Now, that was good for, it wasn't a bottom. It wasn't the end of that previous bear market, but it was good for. I'm going to measure it for you. It doesn't look like a lot there, but from immediately following that deep of an oversold reading, this thing rallied 21.5%. So that's what I'm talking about. So, even bear market rallies can be profitable to trade on the long side. And ultimately, we're nearly as oversold when it put a major bottom in there. That is a textbook selling climax. See that big volume there? I don't know if you can see it here. Just like we had a buying climax right here. But there it is. And, if you went long and grabbed that, nobody would have wanted to buy. Everyone was puking it up. That's the definition of a selling climax. People just give up. And that was, from there, it went up 442%. So I did want to point that out and add these additional things. Now I'm going to flip over to, it's on a different monitor, but this is the watch list of lithium stocks. Tesla's included in there because I believe LIT owns it. And I'm not necessarily, when I queue in LIT, this charting platform, it usually gives me a breakdown of the holdings, but it's not for LIT. It's a blank. So I'm just going off the watch list I have. I believe Tesla may be in there. I'm not certain. And I've already covered Tesla recently, so that wasn't the whole point of this video. I want to cover the other ones. Panasonic Holdings is in there in my watch list. Again, I don't know to what extent, some of these companies may be pure play lithium miners or producers, and some may be, lithium, related, like Tesla, obviously, buying a lot of batteries that require lithium batteries. So I'm going to skip that one. Okay, this one, ALB, you have the nice positive divergence. I'm just going to do this chart and mark it up as I go here. I added that line because I can see back here in late 2018, you had a reaction high there. Then a breakout right here. It was an impulsive move. It was this trading range right here you had, and it broke out. So this one is coming back to a long-term support level with nice, strong positive divergences. Pretty big volume lately on the selling. So it looks like they've been puking up the lithium stocks. I don't know why I don't follow the sector. Maybe it's looking at the polls with Trump ahead and saying he may kill Biden's big green energy plan. Who knows? I don't know. But this is what the market's been doing. It's been selling these stocks off pretty hard. This one, like most of them, you can mark it up there, ended with a big divergent high, negative divergence that have been building for a long time on it. Anyways, there's one. Like I said, I can't make a screaming case to buy. And, if I was bullish the sector, I wanted exposure one of two ways. You can start nibbling in. I personally, and most pros, don't like to average down. So if you took a shot here, maybe around 110, stop somewhat below targets. I didn't mark them up here, but you'd probably target that previous reaction high right there, at least for a bounce. And again, maybe a potential bottom. But I just want to point out I'm seeing more and more of these. Oh, and then if you do start, go in, you can either take a starter position in case we start to rally off these levels, and you'll just have to determine where your stop is on that based on what you're targeting. Are you looking for a bounce trade, or are you looking for a bottom trade? That you're gonna, with these stocks entering a new uptrend. And obviously, you can have higher price targets on a new bull market or uptrend, and you could allow yourself a little wider stop. And then what you can do is, some people average down, but a lot of the pros will only average up. It tells if they're right. So if it starts going up, then you can continue to build and add to your position and or raise your stops. So that's one. SQM, this is a Chilean company here. I don't have, it just took out the divergence, but look, we're deeply oversold. I'm going to put the crosshairs there. The last time, you can see if you follow my crosshairs to the left, we were that oversold. Exact same level was right here. And, I'm going to put the line, I'm going to circle it. You can see what happened there. Had you bought that, and then very indicative of a potential selling climax. The volume isn't as big, but then again, it wasn't huge there either. You could see it. I have to zoom in. I have to lift my volume bars up. I have them really tuned down. I don't even know if you can see them well in the video, but that was and there was a spike in volume, a surge, and that's a textbook selling climax. And if you had the gumption to buy it there, again, playing the game from low to high, you're not going to get every penny out of it, but it was a 671% run. Again, the common traits or the recent potential selling climax, where it looks like people just puked up these stocks. Institutions said, screw it, we're out, or individual investors, whatever, everybody. And then again, you were that oversold. We had an oversold reading there that was deep oversold. It was good for a trade. I'm sure that was well into the double digits, and so forth and so on. So actually I'm glad that one was brought up. These are starting to look interesting. This is FMC. I'm just clicking the list in order of market cap, by the way, because these quickly go down right now. ALB was a $13.4 billion company. ENS, we're already down to $4 billion. I'd have to study these charts a little further, other than, did put in a little divergent high there at the highs. That marked a high, but this one has relative strength in the sector. But I see it says technology sector, electronic components. Sometimes that info is wrong. So this might not even be a pure play. It might be a peripheral, something to do with electronic components that run the, lithium batteries. I have one for my controlling motor on my boat, and there's a whole control panel in there, a circuit board. They're not like lead acid batteries. Even if you buy like I said, for a golf cart or a boat, you've got a whole, so that might be their, a peripheral play on the circuitry put in the batteries. I don't know, because I haven't done my due diligence. That's what you can do. I can tell you from the charts, it's held up a little bit, but I'm also seeing a bit of maybe a head and shoulders pattern with a left shoulder, head, right shoulder. So be careful there. Let me go on. LAC, obviously this sounds like a pretty solid lithium play. Lithium Americas Corp. So it seems a lot of these what appear to be pure play lithium producers have a similar setup in the charts. They have these nice, what I call potential divergences, because these indicators, we really need to get that bullish crossover, turn the indicators, the PPO back up, and the RSI back up. We don't have that yet. What you see here, a bunch of lines, because I've had this before from charting this one back here. There was a trading range right there, and we finally had one whipsaw. That was also a selling climax, also down to extreme oversold levels. And then it proved to be a whipsaw, a lot like IWM in reverse. Remember IWM, we've shorted recently because they had a failed breakout above a comparable sideways trading range, and that's been my experience. Once you have a failed breakout of a trading range, if you re-enter the range, the next stop is usually the other side of the range in a pretty quick fashion, relatively quick, followed by ultimately a breakout above it, and that's what happened there. So we're in that range, guys. All I can tell you, if it continues lower, and I said to the subscriber that asked me for the update, bump me again. I can tell you $3 is going to be very good resistance. Support. It was the bottom of that range. We may or may not get there. These guys do appear to be potential in the final stages of a selling climax. Again, no hard evidence of a reversal, so be careful there how much you take. And you could go in hard. You just have to put a stop and be aware you may be stopped out, because these guys move a lot in percentage terms. This sucker's up 6.27, 6.25% today, and it's just a run-of-the-mill day when you look at that candle. So I always say no. It's what I call the know your security rule. So spin off when I was a broker, know your client rule. And that is, you have to know your client's financial situation. I say the same thing when you're trading stocks. You need to know. If someone says, "Oh, buy LAC or buy natural gas," you don't know the nature of your security, and then in any given day, that thing can go up easily double digits. That's what natural gas does. That's what a lot of these lithium stocks do. If you don't know that, then you don't know to adjust your position size down accordingly. In other words, you don't put the same amount of money into LAC or natural gas. I use that as an example because it's so volatile, as you would into SPY or into Apple. You use a smaller position because your gains, if correct, are going to be outsized, and as will your losses if wrong. So there's LAC. I'm not going to go through them all. I just wanted to show you that quite a few are looking interesting here. Again, no hard buy signals. Extreme oversold reading right there. That one right there, last time we had an extreme oversold reading. Again, it didn't mark the end of the downtrend, but it was good for a counter trend bounce of 57%. I think most swing traders, that's what the site is primarily about, swing trading. So I could give two flips if something's in a bull or bear market. I think that's where I get a lot of confusion on the site too. The last trade I posted on NQ. Well, I take that back. On QQQ, I'll get to in a second. I was short a week ago on Thursday. I'm sorry, long, covering a short, going long off that bounce on Thursday. But then we did hit the bounce target for active trading. And so technically it's, a short right now, but the next sell signal comes on a break of the uptrend line. I'll get to that in a second. So either way, this one's starting to really move off this over extreme oversold reading. You'd probably want to put in, I can't put a great fit. That's probably the best fit if you exclude that candle for a downtrend line. Potential targets. I mean, if we get a bottom in here again, there's potential for a bottom and even better potential for at least a bear market rally. I'll give you a couple targets here. And I'm going to stop here. Now, the thing is, this is why I did this. This is why I had that reply. Some of these, as I go down the line, a lot of these are no longer trading. And you see the .V, that's on the Toronto Venture Exchange. That's like similar, if you will, to our small cap, Russell small cap. You have the TSX, which are your bigger blue chip, like our S&P 500, Toronto Stock Exchange, and then you have the Venture Exchange, and that's the lower priced, higher risk stocks, and some of these are either got bought out or went bankrupt. Okay, and that's that. I'm not going to go through them all, but the takeaway is, well, Randy, you just covered a lot of stocks, to try to get more clarity into the overall sector, because when I look at an ETF, I always say an ETF is simply a sum of its parts. And that's usually the case. In the case of the NASDAQ 100, it's not. Unfortunately, there's 100 stocks in the NASDAQ 100, but you only have to look at the top 7 to know where it's going. But in most ETFs, sector ETFs especially, they're more diversified. So that's why I do that deep dive. And there it is, guys. So there's some potential trade ideas. Feel free to bump me again later in a week, 2 weeks, 3 weeks, whatever it is. 3 months, and I will give an update. Now on to the next question, and the rest of this will just cover the stock market. Someone asked, what happened to the bullish PPO crossover and SPY and QQQ on daily and monthly moving averages on both the S and NQ? So I didn't understand. Where's my reply? Where'd it go? Let me refresh this page. I know I replied to that. Oh, there it is. It came down here. Nope. Oh, because there were a few replies first. Is that why? Yeah. Wow. No. Okay, guys. I don't know. I swear to you, I replied to that, and that's quirky. I don't know if I didn't hit send. Let me pause that. Oh, there it is. I just had to keep scrolling down. All right. So I wasn't clear the way the question was phrased. My apologies. It says, are you referring to the most recent bullish PPO crossovers on the daily time frame? That seems like what they were asking. So my answer is, if so, that's what I've referred to in the past as small or insignificant hills on the PPO histogram. I'll get to that in just 1 second. Stating that I generally focus on bullish and bearish crossovers that follow the big hills on the PPO histogram, since the small hills typically come during periods of sideways or sideways-ish, lower volatility price action, thereby leading to more whipsaws. And then I went on to say, also, please clarify what you're referring to on the monthly moving averages. Does it mean because the indexes are trading above those key long-term averages? I'm not sure there. Let me show you what I'm talking about with the PPO histogram. So we look at the S&P 500, put up the histogram. This is it. This is what I refer to. That's a big hill. In fact, in a recent video I put a purple line there to kind of show you what constitutes a big hill. You get these smaller hills. You're in periods of like, here's a trading range, and you have these small hills, and you'll just get whipsawed all day long. So I don't really ignore those smaller hills. It's these big hills, and the bigger the hill, and the longer, they define typically trends. So if you look above, this big green hill captured that bull trend, and that red hill captured that bear trend, so forth and so on. But this right here was a very small, these have been small hills recently. And then on QQQ, same thing, small. There was the last big hill that we had, and that was a bullish trend. There was a red hill, and it didn't really serve. It went, the market went sideways during it. It didn't really correct. But either way, I'm not putting a lot of faith right now in the PPO crossovers, or giving a lot of weighting, if you will. It's also a function how the momentum's slowing. The markets are grinding higher, but they're not really moving very impulsively higher. All right, a couple more here. Someone made a comment that VIX expiration on the 14th may mark end of the rally. We'll see. VIX is some monster little meme. The bottom indicator. Okay, I didn't. These are just comments. You can look on there. Thank you for sharing, by the way, guys. Appreciate that. Technically, I think I replied to this one here. Oh yeah, here's one. There's some comments made here. I think it's a huge and risky gamble to short the market based on divergences and market breadth weakening. I'll get to that. I replied to that. Talking about what's driving the market are corporate earnings, share buybacks, money supply, yield curve, blah, blah, blah. And they went on to say, I see more than 70% of the Mag 7 and semis are beating earnings, and M2 is increasing, the M2 money supply. I'll get to that in 1 second. So market, basically the market's going up, so you can't short. And so I made a reply to that. So let's see, it goes down here. Okay, so on the first part of that, as I often say, never take a trade that doesn't mesh with your own outlook, risk tolerance, and trading style. Right. So if you don't want to short anything or you don't want to go long anything, no problem. Share your thoughts. I appreciate all feedback, even if it's doesn't mesh with my own outlook or opinion on trade. But this is very important. We're still waiting for QQQ and SPY to break their uptrend lines off the October lows for a sell signal, i.e. an objective swing trend trade short entry. Okay, not to be confused with active trading, because I'll post quite a bit of those lately. So I'm still waiting for that on the large caps, while the current IWM short remains profitable. So here's a case where we're short IWM because that had several objective short entries recently, swing trend trade short entries. I made that very clear, not active trading stuff. I'll get to that in 1 second. Because we're on IWM, we're still below the recent failed breakout above that well-defined 20. It was all of 2022, and so far in 2023, it's a big sideways trading range. I've covered it quite a bit in IWM. So I'll get back to this. Let me just go to the charts here. So what I did is I made a clean board, no other lines except the ones I'm talking about now for a swing short or trend short sell signal on QQQ, and that's this very well-defined uptrend line right there. It comes off the October lows. It was a major low. We had also an identical low in SPY, and we have almost an identical uptrend line. So these are the large caps, the ones I follow, QQQ and SPY. They're very liquid trading vehicles, again, they're the most popular traded ETFs and indexes out there. And that's it. So this is our divergence line. That's a wedge that can grow, it can build, it can eventually be taken out. I'll get to that in a second here. But anywho, that's where we have a short. In fact, the last trade I posted before was a long right there last week. To cover shorts, go long. I expected to bounce off the trend line. That was on that 60-minute chart. I got it out to you this morning. And then we hit the bounce target, and we never even got within more than 1% past that bounce target. So it's still very much the same objective entry as last week. We're within basis points. That was the little downtrend line off the high on the 60-minute chart. So there's QQQ on the clean board. And so again, to reiterate, that's when a sell signal will come, a swing short, a trade that is expected to last not 1 or 2 days like the last active trade, which we're expected to bounce off the trend line, but something that should last weeks, possibly months. And here it is for SPY, the S&P 500. Let me just made a clean board for you this morning. There's your negative divergence. Your divergence lines, it's a textbook bearish rising wedge pattern. Again, comes off the October lows. And so, again, to reiterate, I talked the bearish talk about where I think things are going long term. And that will, and this is where the next objective entry will come on, especially you want to see them both break down to help solidify, you can take a break intraday, all the better if you have a solid daily close below it. And I think I mentioned some BOD or benefit of the doubt levels. And then there's going to be, it's check marks if and as each level goes. There's a trading range for SPY. They'll probably come in and buy the, initial pullback to the top of the range. Get a little bounce there. Again, that's active trader stuff. Or if you're a swing trend trader, just, if you short it, set your stops and let it run, and then periodically lower your stops if you're going for the deeper targets. But that's, this is how, it'll probably play out, something like that. Another bounce in the bottom of the range. Then I think we'll probably make it back down here for another check of the 200-day moving averages. That's a potential, right now, let's just call it a maximum swing target or potential swing target for the, near term. Okay, back to that. So, again, just continue response because I need to make this clear. I keep seeing these different, replies, and I just want to be clear on how, the things I say. So, and again, in reply to that question or the comment, the divergences in negative market breadth, as I've stated dozens of times in recent months, were not and are not sell signals. They're merely conditions that indicate the scope of the next downtrend once the large caps break down. In other words, the levels I just showed you, once we break those wedges, it will quite likely be big. And I'm going to just say a little, and well, why don't I do this now? Well, let me finish up and then I'll give you my analogy. I was going to add to it, too wordy to put in here. Again, on that same comment, regarding Mag 7 earnings, personally, I can't recall when at least 70% of them didn't beat. I mean, I'm sure there's times in there. I even spoke to that recent videos in advance of the earnings. I said they are experts at managing expectations. They can consistently, and again, it's a trillion. Each company, Apple, Microsoft, they're $1 trillion companies, and they're in the business of their stock price. They sell products, they sell iPhones and services, but first and foremost, they are experts at managing earnings, and they consistently manage it to produce beats. So again, no surprise there. And I can't tell you how many times I've seen market tops, whether it's just starts of corrections or end of bull markets, they almost always come on blowout earnings for Apple and Amazon and all these big companies. So just keep that in mind. That's par for the course right there. That's just, if you had 70% of missing, I don't think I've ever seen that, on those big companies. All right, so I went on to say, and this is a big one. I'm glad this was brought up, but we're seeing different things. Not sure what source you're pulling M2 from, but here it is straight from the horse's mouth, i.e. the Federal Reserve, showing a virtually unprecedented and significant drop in M2 money supply, which has only increased steadily. Historically, money supply has always gone up. I'm going to get to that, what that is, if you're not familiar, until about mid 2022, and falling quite a bit since then. Here, I'll pull the chart. Let me do that. Okay, this is Fed, St. Louis Fed. This is the directly from the Fed. This is as far back. I clicked on max, as far back as you go. And again, what is M2? You can read about it down here. Before May of 2020, M2 consisted of M1 plus savings accounts. It's cash, guys. It's money in the bank. It's IRAs, checking accounts. They tell you in here IRAs and money market funds and IRAs, retail money market funds and KIOs and IRAs and stuff like that. It's cash, not cash. It does include that, but also money market. And then they changed it to cover up deposits of less than 100,000. But that's it, and it kept increasing even after that tweak in it. And then something that historically is, I don't believe it's, the data goes back here to the 50s. We've never seen this. And that's been a known driver because over time, as the economy grows, there's more and more cash needed. They need to print more cash. There's more and more transactions going on. Money is being deflated and things like that. So this is unprecedented. Now, I will acknowledge when that they might have been referring to this recent uptick. This is just a zoom in here, but when you go back, that's far from a reversal. And again, the $1 million question, and I honestly don't know the answer, but I agree with the first part of their statement, is that that does definitely influence the stock market when the money is being injected and printed. That's literally money printing injected into the economy. That money finds its way into stocks, bonds, financial assets. So we've seen this unprecedented contraction. And the $1 million question is, when, or if what will the lag effect be? And I don't think we've seen it yet. So to me, that's just a ginormous red flag, not a net positive. And again, if you want to take this little blip up here, if that trend continues and all of a sudden, Fed just starts injecting massive amounts, maybe that will change course, and maybe they'll, just like the rate hikes, there won't be a lag effect to this one. But I just wanted to point that out because that's one of the. I've definitely been, reading about this and hearing about this. And see, there's COVID right there. This is when they, just pulled out the bazookas, hit the nuclear option, and just flooded the financial system with money, printed out of thin air. Everybody got stimulus checks, and businesses got tons of money, and everybody got money, and then that money has been just subtracted from the system. All right, so enough on that. You guys can pull the chart, track it on your own. It's not hard to Google search, M2 money supply. You'll get these charts. Okay, now wrap it up. I'm going to say a couple things. That number one, yes, over time, have seen instances where you've had poor market breadth, deteriorating internals, this, that, and the other, or you've had extreme overbought conditions or negative divergences, all these things I'm talking about, and yet then the market did power through them. I have seen that. It is more the exception than the rule, but it does happen. So let me just first and foremost say that absolutely anything is possible. And, if you want to rank it in probabilities, I put the probability very low. I have a strong degree of confidence these will play out. But here's the analogy now, okay? And last week, if you remember, I said I was away from my desk. I had my annual physical. So this made me think of this analogy, and I think it's spot on as far as everything I've talked about. So I've made it very clear. I can sit here and talk the longer-term bearish talk or bullish talk on something, and there's a big difference of when that time comes. And that, of course, right now, we've had shots I've taken that didn't prove to be it. And then I said, if we take out this, then we're probably going to go up to the marginal new high, which we did. So that was back then. My alternative scenario made it very clear, pivoted right at that October low. That's where unambiguously I said covering shorts, going long, we're going to hit key support. And so, again, it's not like or if anybody's been short since then, I don't know why, honestly. But this is the next sell signal now. So, nobody bats 1,000. So take these shots if they don't pan out. And again, it was long there. And now the next swing trade will be to the downside here if when we get these sell signals. So here's the analogy. Okay. So in one of the comments there was something about, well, yeah, I get it, negative market breadth, poor internals, negative divergences, but the market's just going up. It's ignoring all that. And so I guess the takeaway was you should just be long because it doesn't matter. So you say you go into your doctor and you sit down and you have high blood pressure, high cholesterol, you're 20 pounds overweight. You tell them you've been short of breath lately, fatigue, you even have angina and chest pains. Your doctor's going to say, guess what? You're probably going to have a heart attack if you continue at this rate. And that's what I see in the market. It's probably going to have a heart attack. Now, can that be changed? Absolutely. Your doctor can give you a statin. He can give you blood pressure medicine. He can tell you to exercise, eat right, lose weight. And if all those things change, and guess what? You may not have a heart attack. Even if they don't change, even if you don't get on the statin, you don't start exercising, you may not have a heart attack. But the chances that you're going to have a heart attack if all those conditions I laid out initially are a lot higher than the guy that comes into the guy or gal that comes in his next appointment, next patient, who is in shape, eat right, same age, but everything is check, check, check. Blood pressure's fine, weight's fine, cholesterol fine. So that's what I'm talking about here in probabilities. And I see the same exact thing. I see this market appears to be, a heart attack appears very likely and very high right now, especially, start getting some chest pain or anything like that. That's where I see this mark. Now it's going up. And again, that patient's going to walk out of the office and they may live for another 30, 40 years. But probably not if those conditions don't change. They don't start taking the medication, getting their blood pressure under control, exercising, eating right. So that's it. And that doctor may be wrong on predicting you're going to have a heart attack if you don't change your ways. I may be wrong on where this market's going, but I can tell you this is where you start to, again, these are the sell signals. So those predictions, so to speak, this is where they become actionable on the breakdowns, the sell signals. And again, I've seen many a top that look just like this. Everything appears hunky-dory. Go back in time. I beg you, go back in time. Look at 2007. Look at 2000. The stock market was roaring. It appeared invincible. The market leaders were strong up until the highs. And the economic indicators, the economy was healthy. Nobody saw a recession coming in 2007. I saw one. I was very adamant and vocal about it. It was priced in the charts, and I'd also used to work as a financial advisor for a regional bank, and I was in as an officer of the bank in on the meeting. I saw, and I was in ground zero down here in Southwest Florida, the financial bubble, and I was talking to these mortgage lenders I was tight with and the commercial lenders, and we'd go out and do joint calls on their customers' business. I could see where things were going. It had a very similar feel to today, where it's just the market and the economy seemed invincible. The housing market you couldn't lose. Everybody was in it. It's different. The housing market situation is definitely different this time. But I just want to say that's usually where things turn. But guess what? We keep going up, up, up. You should be not losing any money on SPY or QQQ short. This is your next sell signal. If you're in now, no problem. You are going to have to set your stop wherever it's going to be. You're going to inch higher. Maybe a blow off top. That's one thing I can't rule out either. Something similar to 1999. You get some kind of crazy blow off top, and you won't want to ride that out. I promise you, you will not want to ride out a 1999-ish style blow off top being short. So if you are short now, the large caps, you should have stops based on where your entry price is, your risk tolerance, what your price targets are, your RR. Until then, we're going to wait for these 60 and one daily uptrend lines, the uptrend lines off the October lows to break to trigger a sell signal. And then, on SPY, you'll see that level break and then that level break. These would be check marks. Each one, if and when broken, will open the door for a move down here to this, what I call initial near-term target, the 200-day moving averages. And, we've got some price resistance. We'll see. And, time goes on, and here's what happens. Time goes like this. Maybe we go up a little more first, then we break down. The 200 days might come in higher. Maybe by that time, the 200 days come in here at 460. Can't see out that far ahead, and maybe that's all we get. So we go a little higher, and then we drop down there, and that would be a drop of down to 460, about a 9% drop. So it might be good for just a short, a typical swing trade. And again, for those of you that are just don't care about all those things and want to be long, that's the last long I gave you right there. And if we break the trend line, that's a support. You can buy there if you think we're going higher. And if that breaks, you can buy there, 460, about 467. And if that breaks, that's even a better entry right there, about 460. And if that breaks, those 200 days are even better. So, and it's just how you want to trade it. I'll let you know if and when we get to the 200 days or if and when we get to 460, if I'm reversing for a bounce as an active trader or if I'm covering and going long as a swing trader for higher up. We'll see. Okay, so hopefully there's some clarification. Just kind of that's it. So we're sitting, waiting. I am. And I just want to say on a side note, I've lost interest. I've been in and out of, lately I've put a few trade ideas short and long on Bitcoin. I told you I closed that out, what was it, beginning of last week, a week before. Haven't been back in. Even the commodities I had some positions in wheat and soybeans, and they're just kind of going nowhere now. I may re-engage. My focus has been more and more on the markets. And I did tell you last week I'm going to look for additional trade ideas. I'm just not seeing a lot out there that I'm comfortable with on the long side. The short stuff that are short setups. We do have some actionable short semis. Still can make a case to be short semis in the small caps, but the large caps need to break. And that's it. So I showed you some lithium stocks today. Maybe I'm not super hot about them. It's just it's a different sector, and I'll continue to look for some obscure sectors that might offer some, attractive long entries. And likewise, if I see a sector that I think looks like a good short, I'm going to sell that. I'm going to share that and sell it short. And that's what I'm seeing a lot of. I just see a lot more bearish setups despite current uptrends, just like SPY. This is a bearish setup, an untriggered setup, not an actionable trade. Will be if and when that goes. And then that, and then that. Okay, I'm going to wrap it up here, guys. This has been Randy Finney with Right Side of the Chart. Have a great day.